The financial markets are sending signals that most people are completely missing right now. While everyone's focused on their stock portfolios and watching the daily news cycle, something extraordinary is happening behind the scenes. Central banks around the world are quietly preparing for what could be the most significant monetary shift in decades, and gold is at the absolute center of it all. Let me show you what's really going on. When you look at the data, not the headlines, but the actual hard numbers, a pattern emerges that's impossible to ignore. Central banks have been accumulating gold at a pace we haven't seen in modern history. We're talking about hundreds of tons being purchased quarter after quarter, and this isn't slowing down. It's accelerating. Now, why would the world's most sophisticated financial institutions, the ones with access to every piece of economic data imaginable, be loading up on a metal that mainstream financial advisors have been calling a barbarous relic for years? Think about that for a moment. These aren't amateur investors making emotional decisions. These are central banks with teams of economists, strategists, and analysts who spend every waking hour studying global markets. The National Bank of Poland has been particularly aggressive, ramping up their purchases significantly. But they're not alone. From Asia to the Middle East to Eastern Europe, central banks are converting their dollar reserves into physical gold at an unprecedented rate. And here's what makes this even more interesting. They're not just buying gold, they're repatriating it, moving it from vaults in London and New York back to their home countries. When was the last time you saw institutions go through the massive expense and logistical complexity of physically moving tons of gold across continents, unless they had a very specific reason? Let me paint you a picture of what the market structure looks like right now. Gold has been hitting record after record, pushing past levels that analysts said were impossible just months ago. We've seen moves that have left traditional technical analysis in the dust. But here's what most people don't understand. The price you see quoted, that number flashing across financial news networks, that's largely determined by paper contracts traded on exchanges like the COMEX. These are promises to deliver gold, not actual physical metal changing hands. And here's where it gets fascinating. The ratio between paper gold contracts and actual physical gold available for delivery has been growing wider and wider. Think of it like a game of musical chairs, except there are 100 people playing and only 10 chairs. Everything's fine until the music stops and everyone tries to sit down at once. What happens when all these paper contract holders decide they want actual physical delivery? What happens when the countries and institutions holding these contracts say, "We don't want to promise anymore. We want the real thing"? Before I go further, I want to mention something quickly. If you're watching this and you have retirement savings, I've put together a free guide in the description that breaks down the wealth protection strategies that thousands of American retirees are using right now. It's completely free, no strings attached. Just check the description below when you get a chance. Now, let's talk about what's driving this unprecedented demand. It's not just one thing. It's a convergence of factors that are all pointing in the same direction. First, you have the geopolitical situation. The world is fragmenting. The post-World War II order that established the dollar as the global reserve currency is being challenged in ways we haven't seen before. BRICS nations are actively working on alternative payment systems. Trade is increasingly being settled in currencies other than the dollar. And every time that happens, every time a major oil deal gets done in yuan instead of dollars, or every time countries bypass the SWIFT system, it chips away at dollar dominance. But here's what makes this different from past challenges to the dollar. This time, there's a viable alternative that's been around for 5,000 years. Gold doesn't care about politics. It doesn't care about sanctions. It can't be printed into existence by a central bank. And most importantly, it's no one's liability. When you hold physical gold, you're not depending on any government or institution to make good on a promise. You're holding an asset that has maintained its purchasing power across centuries. Let me give you a specific example of how this plays out in the real world. Imagine you're a central bank in a country that's watching the weaponization of the dollar through sanctions. You've seen what happened to Russia's dollar reserves. You've watched as countries that fall out of favor with Western powers suddenly find their assets frozen. What do? You diversify. And the ultimate diversification, the asset that can't be frozen or seized remotely, is physical gold sitting in your own vaults. This isn't theoretical. This is exactly what's happening right now. And the implications are staggering, because as more central banks make this calculation, as more countries decide they need gold as a hedge against a dollar-dominated system, the demand pressure on physical gold intensifies. And remember, gold mining production is relatively flat. We're not discovering massive new gold deposits. The easy gold has already been found and mined. So you have increasing demand running into relatively fixed supply. Economics 101 tells you what happens next. But there's another layer to this that most people completely miss. The commercial banks, the big players who trade gold futures, their positioning has been shifting dramatically. These are the institutions that typically bet against gold, that sell futures contracts to profit when prices fall. But look at their recent positioning. They've been reducing their short positions, covering their bets against gold. Why would they do that unless they saw something coming that made them uncomfortable being on the wrong side of this trade? And then you have the ETF flows. Exchange-traded funds that hold physical gold have been seeing massive inflows. Institutional investors, pension funds, sovereign wealth funds, they're all allocating more capital to gold. These aren't retail investors making emotional decisions. These are sophisticated institutions with mandates to preserve capital over decades. When they move for a reason. Let's talk about the technical picture for a moment, because it's actually quite revealing. Gold has broken through resistance levels that held for years. It's established new support levels that would have seemed absurd not long ago. The chart pattern, if you know how to read it, is telling a story of accumulation. Big money is buying. They're not day trading. They're building positions. And they're willing to buy at these elevated levels because they see something bigger coming. Now, I want to address something that I hear all the time. People say, but gold doesn't pay interest. It doesn't generate cash flow. Why would I own it? And that's actually the wrong question. The right question is, what is gold protecting me from? Because gold isn't an investment in the traditional sense. It's insurance. It's a hedge against the debasement of fiat currencies. It's protection against the kind of monetary chaos that happens when governments and central banks lose control of their currencies. And here's the thing about insurance. You don't buy it because you think nothing bad will ever happen. You buy it precisely because you understand that bad things can and do happen. And when they do, you want to be protected. Think about the retiree who spent 40 years building up a nest egg. They did everything right. They saved, they invested, they planned. But what happens if the currency that nest egg is denominated in loses significant purchasing power? What happens if inflation, real inflation, not the manipulated government statistics, but the actual cost of living, erodes their savings? This is where gold has proven its worth throughout history. During the 1970s, when inflation was running rampant and the dollar was losing value, gold went from $35 an ounce to over $800. It preserved purchasing power when everything else was being destroyed by inflation. In the aftermath of the 2008 financial crisis, when central banks around the world were printing money at unprecedented rates, gold surged again. It did exactly what it was supposed to do. It protected wealth when the financial system was in crisis. And here's what keeps me up at night. The amount of money printing that happened after 2008, the quantitative easing, the bailouts, the stimulus, all of that pales in comparison to what we've seen in recent years. The money supply has exploded. Government debt has reached levels that would have been considered impossible just a generation ago. And the only way out, the only way governments can service these debts without defaulting, is to inflate them away, to make the currency worth less, so the debt becomes easier to pay. But here's the catch. When you inflate the currency, you're not just making the debt easier to pay. You're making everyone's savings worth less. You're stealing purchasing power from savers and giving it to debtors. And the biggest debtor of all is the government itself. So they have every incentive to keep this game going, to keep printing, to keep inflating, to keep kicking the can down the road. And gold? Gold is the canary in the coal mine. It's telling us that smart money, the central banks, the institutions that understand how this game works, they're preparing for what comes next. They're moving out of paper promises and into hard assets. They're building positions in the one asset that can't be printed, that can't be debased, that has survived every monetary crisis in human history. Let me tell you about something that happened that most people don't know about. Back when the London gold pool collapsed in the late 1960s, central banks had been trying to suppress the gold price to maintain confidence in the dollar. They were selling gold into the market to keep the price at $35 an ounce, the official price set at Bretton Woods. But the demand was too strong. Private buyers, particularly in Europe, kept buying. The central banks kept selling, and eventually they ran out of gold to sell. The pool collapsed, and shortly after, Nixon closed the gold window, ending the dollar's convertibility to gold. The price of gold exploded. Now, I'm not saying we're in exactly the same situation, but there are parallels that are hard to ignore. You have official prices, official narratives about the strength of the currency, about the health of the financial system, and you have the market, the actual buyers and sellers, telling a different story. You have central banks accumulating gold while telling their citizens that everything is fine. You have a disconnect between what's being said and what's being done. And this is where it gets really interesting for anyone thinking about their financial future, because we're at an inflection point. The decisions being made right now by central banks, by governments, by major financial institutions, these decisions are going to shape the monetary landscape for decades to come. And if you're not paying attention, if you're not positioning yourself accordingly, you could wake up one day and find that the rules of the game have changed completely. Quick aside here, and this is important. If you're sitting on retirement savings, particularly if you have over $100,000 in retirement accounts, you need to understand how gold IRAs work. I've put together a comprehensive guide that covers exactly how you can get physical gold into your retirement account without triggering tax penalties. It's in the description below. This isn't about making a quick profit. This is about protecting decades of hard work from the kind of monetary instability we're seeing build up in the system. It's worth checking out if wealth preservation is something you're thinking about. Anyway, let me get back to what's happening in the markets right now. The supply side of the gold equation is something that doesn't get nearly enough attention. Gold mining is an incredibly difficult, capital-intensive business. It takes years, sometimes decades, to bring a new mine into production. You have to find the deposit, which is getting harder because the easy-to-find gold is already gone. Then you have to get permits, which in many jurisdictions is becoming increasingly difficult. Then you have to build the infrastructure, the roads, the processing facilities, the power supply. And all of this requires massive capital investment with no guarantee of success. And here's the kicker. Even when everything goes right, even when you successfully bring a new mine into production, the ore grades are declining. Miners are having to process more and more rock to get the same amount of gold. This means higher costs, more energy consumption, more environmental impact. The all-in sustaining costs for gold miners have been rising steadily, and there's a floor under the gold price based on these production costs. Below a certain price, it doesn't make economic sense to mine gold. Mines shut down, supply contracts. So you have this situation where demand is surging, particularly from central banks and institutional investors, while supply is constrained by the physical realities of mining. And in the middle, you have the paper gold market, the futures and derivatives, creating the illusion of unlimited supply. But it's just that, an illusion. Because at the end of the day, you can't eat a futures contract. You can't store wealth in a derivative. When people want the real thing, when they want physical metal they can hold, the paper market becomes irrelevant. And we're starting to see cracks in this system. There have been moments, brief moments, where the premium for physical gold over the paper price has spiked, where people were willing to pay significantly more for actual metal than what the futures market said it was worth. These are warning signs. These are indications that the paper market and the physical market are starting to diverge. And if that divergence becomes permanent, if we reach a point where the paper price is no longer credible, the repricing of gold could be swift and dramatic. Think about what that means for a moment. If you're holding paper gold, ETFs, futures contracts, mining stocks, you're exposed to counterparty risk. You're depending on someone else to make good on their promises. But if you're holding physical gold, actual coins or bars in your possession or in a secure vault that you control, you have no counterparty risk. You own an asset that has intrinsic value, that has been recognized as money for thousands of years. And this is where the conversation about gold becomes deeply personal, because we're not just talking about abstract market forces. We're talking about your financial security. We're talking about the nest egg you've spent decades building. We're talking about your ability to maintain your standard of living in retirement, to leave something for your children and grandchildren, to weather whatever economic storms might be coming. The mainstream financial advice has been the same for decades. Put your money in stocks and bonds, diversify across different sectors, rebalance annually, and for a long time in a relatively stable monetary environment, that advice worked reasonably well. But we're not in a stable monetary environment anymore. We're in uncharted territory. The amount of debt in the system, the level of money printing, the geopolitical tensions, the challenges to the dollar's reserve status, these are not normal conditions. These are the kind of conditions that require a different approach to wealth preservation. And gold, physical gold, has always been the ultimate safe haven in times of monetary uncertainty. It's not about getting rich quick. It's not about speculation. It's about having a portion of your wealth in an asset that can't be devalued by government decree, that can't be frozen by executive order, that maintains its purchasing power across generations. It's about sleeping well at night, knowing that no matter what happens in the financial markets, no matter what decisions politicians and central bankers make, you have a foundation of real wealth that can't be taken away. Let me share something that really drives this home. There's a concept in finance called real returns. That's your return after accounting for inflation. And when you look at real returns over long periods, particularly during times of high inflation or currency debasement, gold has consistently outperformed. Not because gold itself is going up in value, but because the currency it's priced in is going down. Gold is the constant. It's the measuring stick. And when currencies lose value, it takes more of them to buy the same amount of gold. This is why central banks hold gold. This is why the world's wealthiest families have always maintained significant gold holdings. This is why, throughout history, in every major monetary crisis, people have fled to gold. Because it works. Because it preserves wealth when everything else is falling apart. And right now, all the indicators are pointing toward a period of significant monetary instability. The debt levels are unsustainable. The political will to make the hard choices necessary to fix the fiscal situation doesn't exist. The path of least resistance is to inflate, to print, to devalue. And in that environment, holding assets that can be printed into existence, that are denominated in currencies that are being deliberately devalued, is a losing proposition. You might see your account balance go up in nominal terms, but in real terms, in terms of what that money can actually buy, you're losing ground. And here's something that really concerns me. The average person, the retiree, who's counting on their savings to last through retirement, they're not thinking about this. They're looking at their account statements, seeing the numbers, and assuming everything is fine. But those numbers are denominated in a currency that's losing purchasing power. The real question isn't, how much money do I have? The real question is, what can that money buy? And if the answer to that second question is less and less each year, then you have a serious problem. This is where gold comes in as a solution, not as your entire portfolio, not as a get-rich-quick scheme, but as a meaningful allocation, a core holding that provides stability and purchasing power preservation when everything else is uncertain. The exact percentage depends on your individual situation, your risk tolerance, your time horizon. But having some exposure to physical gold, particularly in the environment we're in now, isn't radical. It's prudent. It's what the smart money is doing. And when I say physical gold, I mean actual metal, not paper proxies, not mining stocks, not ETFs that might or might not have the gold they claim to have, actual coins or bars that you can hold, that you can store securely, that are yours free and clear. Because in a real crisis, in a situation where the financial system is under stress, that distinction matters enormously. The person holding paper gold might find out that their claim on physical metal is worth a lot less than they thought. The person holding physical gold knows exactly what they have. Now, let's talk about timing, because that's what everyone wants to know. Is it too late? Has gold already run too far? And here's my answer. If you're thinking about gold as a speculation, as a trade, then timing matters a lot. You want to buy low and sell high. But if you're thinking about gold as insurance, as wealth preservation, then timing matters much less. Because the goal isn't to make a profit. The goal is to protect what you already have. And based on everything I'm seeing, based on the central bank buying, the geopolitical tensions, the monetary instability, the debt levels, the money printing, We're still in the early stages of this move. Gold has been hitting records, yes. But when you adjust for inflation, when you look at gold in real terms, we're not even close to the previous peaks. There's significant room for gold to move higher just to catch up with the devaluation that's already occurred. But more importantly, the structural factors driving gold higher aren't going away. The debt isn't going to magically disappear. The geopolitical tensions aren't going to resolve themselves overnight. The challenge to dollar hegemony is going to continue. Central banks are going to keep buying. And as more people wake up to what's happening, as more investors and savers realize they need protection, the demand for physical gold is going to intensify. This is the setup. This is why the market is preparing for what could be a historic repricing of gold relative to paper currencies. And if you're not positioned for it, if you're entirely in paper assets denominated in currencies that are being deliberately devalued, you're taking on enormous risk. Risk that most people don't even realize they're taking because it's not talked about in mainstream financial media. The financial establishment has a vested interest in keeping people in the system, in paper assets, in stocks and bonds and currencies, because that's where they make their money. That's where the fees are. That's where the control is. But gold? Gold is outside the system. It's independent. It's no one's liability. And that makes it dangerous to the status quo. That's why you see so much negative press about gold. That's why financial advisors often dismiss it. Because if people start moving significant portions of their wealth into physical gold, it threatens the entire structure. But here's what they don't tell you. The people at the very top, the central bankers, the ultra-wealthy, the sovereign wealth funds, they're not dismissing gold. They're accumulating it. They're moving it. They're building positions because they understand what's coming. They understand that the current monetary system is unsustainable. They understand that when the reset comes, and it will come, gold is going to be at the center of whatever new system emerges. And you have a choice. You can listen to the mainstream narrative, the one that tells you everything is fine, that the system is stable, that you should just keep doing what you've always done. Or you can look at what the smart money is actually doing, not what they're saying, but what they're doing. And what they're doing is buying gold, lots of it, as fast as they can. The window of opportunity to position yourself before this becomes obvious to everyone is closing. Not because gold is going to disappear, not because you won't be able to buy it later, but because the price at which you can acquire it is going to be significantly higher. And more importantly, the availability of physical metal, particularly in size, is going to become more constrained. When everyone wants the same thing at the same time, when the rush for the exits begins, being early matters. This isn't about fear. This isn't about panic. This is about clear-eyed assessment of the risks in the current system and taking prudent steps to protect yourself. It's about understanding that the rules of the game are changing, that the monetary system we've known for the past 50 years is under stress, and that having a portion of your wealth in an asset that has survived every previous monetary crisis is simply smart planning. For those of you who've made it this far, who've stuck with me through this entire analysis, I want to offer you something special. In the description below, there's that free guide I mentioned earlier. But if you're serious about this, if you're ready to take action, I've also arranged for exclusive one-on-one educational web conferences. These are completely free, no obligation, but they're only available to American retirees with at least $100,000 in retirement accounts. If that's you, mention that you watched this video all the way through, and you'll get priority access. This is about education, about understanding your options, about making informed decisions about your financial future. The market is preparing for a shutdown of the old system and a transition to something new. The signs are everywhere if you know where to look. Central banks are positioning themselves. Institutional money is moving. The smart money is accumulating gold. The question is, are you going to be positioned for what's coming, or are you going to be caught off guard when the transition happens? The choice is yours, but the time to make that choice is now, while you still can, while physical gold is still available at prices that, in hindsight, are going to look like an incredible opportunity.